Year 2140. The last Bitcoin gets mined. From that moment on, miners receive no block subsidy at all. Zero. Last episode, I left you with a question. If miners start shutting down, hash power collapses, but tens of thousands of full nodes are still running around the world. Is Bitcoin still secure? Today, we're pulling that question apart. The answer is more complicated than most people think. First, let's quickly rewind the halving mechanism. In 2009, Satoshi mined the first block, and the reward was 50 BTC. Here's a detail most people miss. Bitcoin wasn't designed to halve every 4 calendar years. It halves every 210,000 blocks. Because early hash power grew faster than expected, blocks came out quicker than the original schedule assumed. So the first halving arrived in 2012. Then came 2016, 2020, and 2024. Keep extending that curve, and by roughly 2140, the subsidy approaches zero. More precisely, it falls to 0.000001 BTC, so tiny it is effectively irrelevant. In other words, a miner can grind through an entire block, and the protocol pays almost nothing. So why would anyone keep mining? That brings us to the first mechanism in Bitcoin's design, the fee market. Every Bitcoin transaction can attach a fee. The higher the fee, the higher the priority miners give it. It's basically an auction. Block space is limited. A block can only fit roughly 4,000 transactions. Want to cut the line? Pay up. Global Bitcoin transaction volume already clears more than $10 billion a day. Supporters argue that as adoption grows, demand for block space grows with it. Supply stays fixed, demand rises, fees go up. That's standard economics, but only if demand keeps showing up. After the fourth halving in 2024, fees really did spike for a while. In some blocks, fee revenue even exceeded the block subsidy. But that was a short burst, not proof of a stable long-term trend. So what if fees aren't enough? Bitcoin has a second mechanism, difficulty adjustment. Think of it like an automatic water pressure regulator. The faucet's output stays constant. When pressure in the pipe gets too high, meaning too many miners, the system tightens the valve and mining gets harder. When pressure drops, meaning miners leave, the system loosens the valve and mining gets easier. Every 2016 blocks, roughly once every 2 weeks, Bitcoin recalculates mining difficulty. If the previous period produced blocks too fast, hash power went up and difficulty rises. If blocks came too slowly, miners left and difficulty falls. What does that mean in practice? Imagine half the miners shut their machines off. Difficulty doesn't stay frozen. It drops automatically, so the miners who remain can still find blocks with less hash power and less electricity. Their margins actually improve. That creates an economic feedback loop. When mining stops being profitable, inefficient miners exit, difficulty falls, and the survivors become more profitable. When profits get too rich, new miners rush in, difficulty climbs, and margins compress. In theory, the system keeps searching for equilibrium. One block every 10 minutes, over and over. But pay attention, in theory. You may still be wondering, if Bitcoin's base layer can only handle around 4,000 transactions per block, won't fees eventually get so absurd that normal people are priced out? That leads to the third mechanism, Layer 2. The most famous example is the Lightning Network. Imagine Bitcoin's base layer as the central bank's master ledger. Every entry is final. Every entry is immutable. But if you had to register every coffee purchase directly at the central bank, the system would be unusably slow. Lightning is basically the payment rail built on top of that ledger. You open a channel with a coffee shop and transact inside it 10 times, 100 times, without touching the chain. Only when the channel closes does the final balance settle back to Bitcoin. That means the base layer can focus on large value settlement. If you're moving $10 million across borders, paying a $50 fee is totally reasonable. Meanwhile, day-to-day spending can happen on Lightning, where fees may be just a few cents. At least in the design vision, Bitcoin's base layer evolves into a settlement layer for value, while small everyday payments move to Layer 2. Different jobs, no interference. Now put those three mechanisms together. First, the fee market. Supply and demand discover the price. Second, difficulty adjustment. The system rebalances itself and preserves the block cadence. Third, Layer 2. Small payments get pushed off-chain, freeing scarce block space. These three pieces interlock. Satoshi's intent was obvious. Even without block subsidies, Bitcoin should keep running. But design intent is one thing. Reality is another. For this machine to keep working, one condition has to hold. Miners must stay profitable. Miners are not volunteers. They're businesses. If mining revenue drops below electricity and hardware costs, they shut down. That isn't speculation. It's economics. So the real question becomes, when block rewards go to zero, who pays for Bitcoin's security? The answer is fees, which means, in the end, users pay for it. And that creates a brutal dilemma. If fees are too low, miners lose incentive, hash power falls, and security weakens. If fees are too high, say a single transfer costs $100, ordinary people get pushed out. That's what the industry calls the security budget. Code can guarantee that rules are enforced, but code cannot guarantee that enough people are willing to pay for that enforcement. In the end, Bitcoin's security is not decided by technology. It's decided by economics, by whether enough people are willing to pay the real cost of keeping this network alive. That question still has no final answer, but anyone who cares about Bitcoin should take it seriously. Next episode, we'll go deeper into the security budget, Lightning, settlement layers, and Bitcoin's long-term survival. I'm BitDogga.